Hello, YouTubers, friends, compatriots, bootlickers, shills, debt slicers, peasants, vassals, minions, meat sacks, first-time home buyers. Just kidding. Welcome. I'm a useful idiot, and I want to talk a little bit more about the fake housing recovery. And now this latest interesting development, Fannie and Freddie are going to get back into the housing bubble market. And the timing seems to be perfect in a lot of ways. We have institutional investors are finally either staying in one place or backing out of the market as they feel that housing prices have peaked. And we have areas that used to have heavy investment and still have a certain amount of heavy investment of institutional investors, areas like Phoenix that now have a 50% increase in properties that are on the market. But let's get back to this main story, and that is Mel Watt. And to refresh your memory, Mel Watt was the House of Representative member from North Carolina who derailed the original audit the Fed, or at least the most successful attempt to audit the Fed. And it might have even passed had Mel Watt not interfered. And one of the reasons why Mel Watt was interested in interfering is because in his home district was the home office of Bank of America. That's where their headquarters is. And Mel Watt served the bankers well. And no surprise that the Barack Obama administration would appoint Mel Watt to be the head of Federal Housing Finance Agency now. And so he oversees Fannie and Freddie. And interestingly, there was a lot of talk about winding Fannie and Freddie down and getting rid of these two institutions. And now we see them actually getting revved up and back in business, and that's a worrying sign. So let's remember that Fannie and Freddie were at the center of the real estate meltdown 6 years ago, and two quasi-government agencies who don't handle mortgages per se as much as are involved in repackaging them in securities and selling them. And so the banks would love to see Fannie and Freddie back in business, I'm sure. And so the government's just made it easier to buy a home. And that's another problematic point here, because that's also partially what got us into economic crisis last time as well, was the ease by which under the Clinton and Bush administrations underwriting standards were lowered in order to get more and more people into mortgages and the fraudulent industry in order to generate more securities and more profits for the banks. And they would love to get that institution lined up again. And the fact of the matter is there's not too many first-time buyers. In fact, first-time buyers only make up 29% of the market right now. The rest is all institutional, foreign, and people finding some mobility in the market. But a lot of people are also having problems having mobility in the market because 20 million mortgages are still underwater, and so they cannot move. And so we have the recreation of the subprime industry happening here. The institutional buying spree is nearing an end, and so we're going to need something to fill the void, and here comes Fannie and Freddie. The interest rates are already at a historic low, and yet we still can't get first-time buyers and get the real estate industry revved up. And the reasons are obvious, since we have people from 24, I think something like 47% of people from 18 to 34 are living with their parents again, college grads, or 24 to 34, something like that. And they're saddled with a trillion and some change in student loan debt at this point, and there's no jobs out there, and in fact wages are going down. And so now we have Fannie and Freddie getting back in the market, and this is a reversal of the policy of the last 5 years, as I mentioned, of getting Fannie and Freddie out of the market. And Fannie and Freddie has paid some $180 billion to the Treasury, so their bailout was $188 billion, and they paid $213 back so far. So Fannie and Freddie has ended up being profitable for the government. But this is interesting because not only are Fannie and Freddie getting back in the housing business, are getting back into the real estate business, but they're also throwing another bone to the banks here because, simply put, Fannie and Freddie will give banks more protection against the risk of being forced to buy back mortgages that go bad. The theory is it will make banks more willing to lend to riskier borrowers. So that sounds like the recipes that we've had for disaster before. So first of all, encourage the banks by backing them by having the government and U.S. taxpayers back these risky loans, and encourage the bank to make these risky loans and these risky borrowers and subprime loans and package them in securities. And here we go again. And but this time the banks are going to have protection. So if there's another economic collapse and these round of repercussions and feedback loops happen again, then now the banks are going to be protected from these buyback, having to buy back these mortgages, which is where we are now with Fannie and Freddie in their battles with all the big banks. And we also have a situation where all the federal agencies will have new rules for mortgages that are packaged into securities by private investors. And the rules largely abandon earlier proposals requiring larger down payments on mortgages in certain types of mortgage-backed securities. So there's another check and balance point that's been eliminated that would have protected the government, the U.S. taxpayers, and the economy from the same kind of damage we've seen before. And once again, it's gutted, and we find less safeguards. So all the federal agencies will now have new rules for mortgages that are packaged in securities by private investors. The rules largely abandon all the earlier proposals requiring larger down payments. So once again, encouraging subprime loans, riskier borrowers, lower down payments, more risk, and all to get the mortgage-backed securities industry revved up again. And this is also at a time when new studies come out and said that mortgage risk index is at an all-time high. So the factors going into the real estate at this point mathematically are at an all-time high. And rather than go into the dry details, I'll just attach that report below. And then also on top of that, we have figures in that total year-to-year home sales are down 7%. Year-over-year home sales are down 7%. And interestingly enough, if you just look at the low end of real estate, it's plunged 17%. And that's where the real estate market for real people is. And that's year-over-year home sales down 17, so nearly 20%. And then at the high end, as we also know, in the current real estate market, 7%. It's up 7% because luxury and mini mansions and the like are still a hot commodity. And but like I say, inventories are starting to build up, and we are seeing Fannie and Freddie jump back in right now, just as a little steam is coming out of this fake housing recovery that's going on right now. And Watt has also decided not to lower the size of the mortgages Fannie and Freddie can buy from banks. And once again, another free ride for the banks now that Mel Watt is in charge of Fannie and Freddie in the Federal Housing Finance Agency. He's not going to lower the size of the mortgages Fannie and Freddie can buy from banks. So this is all lining up very nicely. So what we have here is another attempt to artificially boost the real estate market, which has been artificially boosted for the last 5 years. Anyway, we're seeing an attempt to get the mortgage-backed security industry on its feet again so the banks can have their cash cow. We're seeing massive leverage again in this real estate market. We have a new housing bubble that is bursting, and we have Fannie and Freddie jumping in at a precipitous time. And this is about the banks. It's not about home buyers. So let's let's keep that in mind. And then, of course, the biggest surprise about all of this is the fact that we're going to have Fannie and Freddie back in business again after all these years of talk about winding down. And this is in an atmosphere where globally we have real estate markets blown in countries on every continent around the world right now. And the one in China is certainly the most notable. But the U.S. Housing market is certainly not off the hook by any stretch. And then of course my favorite bottom line here is we have Mel Watt, this insider bootlicker lackey for Bank of America and the banking industry, who's now in charge of housing, in charge of mortgage-backed securities, in charge of this whole debacle. And the banks are getting their payoff right away. And another despicable appointment by the Obama administration. I'm a useful idiot. Don't you be one too.